Hey, good evening. Good evening. How's everybody?
Good evening, Professor.
Hey, good
Evening,
evening.
Professor.
Good evening, Anna. Good evening, Devin.
Good evening, Professor.
Hey, good evening. Well, I'm glad that you're all here. I'm glad to see everyone here. I see 10 people, 11
Ah,
now, 11 in the collaborate, and let's see how
Good
many
evening,
are
Professor.
here. Hey, good evening. Let's see how many are in the forum. Okay, I see 10 in the forum, so that means I see more people in the collaborate. So that means I see 11 here. So one person here still needs to report attendance in today's forum. I'm
yes,
glad people were um,
I'm doing it now.
diligent enough to discover my email, right? I sent out this email twice, right? Once yesterday and another one today. And so there was another class, Finance 100 class at 3 o'clock, and these people were somehow, I don't know why, they are completely unaware that the email was sent out. Um, so, uh, but I'm glad most of you have found your way here. I have 13 people, so there should be yeah, two more people than. Oh yeah, actually there are more here, more in the today's forum. All right, good. So let me just start a new. Uh, so we did everything about in our last class. We did everything about the financial statements. We did, basically uh, everything about income statement, and then balance sheet, and we haven't done yet cash flow analysis. That's the next topic. Cash flow analysis. That's the next topic. So we're gonna get to that on Wednesday. Today, actually, what we want to do is depreciation. Uh, Depreciation. Okay, this line item, it belongs to both, right? Income statement and balance sheet. And I've been telling you over and over, because they serve different purposes, right? Income statement and balance sheet serve different purposes. They are not so. The line items, the line items are different. Well, the line items in the balance sheet and income statement are different, but there are only things that are two things that are common to both income statement and balance sheet, and that are um, depreciation and interest. So, um, depreciation is the very important line item, especially it appears, remember, in the income statement, it appears in the operating expenses, right? Depreciation appears in the operating expenses in the income statement, and in the balance sheet, um, in the balance sheet, um, it appears in the uh, non-current assets, or physical assets or fixed assets, right? Because depreciation is literally the depreciation of the physical assets, right? Plant and equipment. So, therefore, it is really worth. It's really worth, spending our time, dedicating some of our time on depreciation, because in a lot of people understand depreciation as something that reflects the depreciation in the value of our physical assets. That's true. But that's not only that. But then you might wonder, why is it appearing in the income statement? Why is it appearing in the why is it appearing in the income in the operating OPEX part, operating expenses section of the income statement? So let's yeah, that's an interesting thing. Think about it. Yeah. So here's our balance sheet and income statement. Depreciation appears here, right? And then it should be reflected here. It's not here. It's not shown here. But if we go to other example, let's see. Do I have another example? Yeah. Yeah. Depreciation is shown here. And the same, right? Oh, what is this? Why is it suddenly 400%? And the number showing here and the number showing. Okay. Number showing here and the number showing here, right? Depreciation. These numbers must match. But think about it. Yeah, plant and equipment, they wear and tear. I mean, the depreciation, the reason for the depreciation is because of the wear and tear, right? It's because of the wear and tear. Think about it. All the assets age. With age they wear and tear. As you use them, wear and tear. I mean, things break down, right? Cars get old, right? They wear and tear. So obviously the value cannot be the same thing. I mean, even if in case of car, right? When you buy a new car, let's say it's $50,000. But the minute you drive it out of the dealership, right, the value goes down drastically. Although you haven't put even 50 miles on it yet. And why? Of course, that's irrational. I mean, obviously, that's not a rational. I mean, if the car has put only 50 miles since you bought it, and from 0 to 50 miles, right? Then obviously there's slight wear and tear. I mean, tires are worn. I mean, obviously as you drive, but no damage to the car, no dent, no physical dent on the surface of the car, no nothing. I mean, it's still in mint condition, but the minute you drive it out of the dealership, it loses value. But that is resale value in the market, and that's irrational because everyone understands that if you barely have used it, then it should still retain 99% of its 99% of its original sale value, right? So let's think about it more, logically. Depreciation reflects, wear and tear in the plant and equipment. But then why is it an expense? Why is that an expense? Why is it in the OPEX? Why is the depreciation reflected in the OPEX? Shouldn't it just be, now it's so the reason it is reflected both also in the operating expenses is because they consider depreciation as the payment you make as you go, right? Suppose the company has bought a car, the company car and the so let's say company bought a car. I guess I better do it. I better do it on the side. So let's say but when the car is owned by a company, it's different from when it is owned by you. If a car is owned by you, it's a personal vehicle, right? It's a personal vehicle. Well, if the company owns the car, it's a business. It's an asset. It's a car is a business asset. In other words, a car is a fixed asset. Right? A vehicle is a fixed asset. Now, your personal car is for personal use, but company car is for business use. In other words, what is an asset? Asset is something that generates income. Isn't that right? We defined asset before. Asset is something that generates income. And the company car is being used for that purpose. Right? Was someone trying to say something? Although it may be just, the car may be just, the company car may be used just to just for the CEO to or some company executives to get to point A from point B to point A. But all those activities, right? If the CEO or CFO is using the company car to get to the conference or to get to the airport or to give a ride to the client that visits the company, all of these are part of the operating activities, right? So it is a business asset, and the expense related with the car is the business expense, right? And then suppose the value of the car is $50,000, right? And then suppose the company is renting this car. If the company is renting this car, and for 5 years, right? Every year, the company is paying, let's say, $10,000 every year, 10K, to use this car for 5 years, right? Then for 5 years, they will be this 10K, 5 of them, right? These are basically the expenses that the company incurs, right? Until, so this car is rented by the company, and the rental for 5 years, the company fully uses this car, utilizes this car until its value runs down to zero, right? I mean, think about it. Just like the machinery, just like the production equipment, if the production equipment is well used, fully maximized, fully maximally used, then the production equipment will completely have to, disintegrate, right? Let this be a good example. Your shoes. You bought a pair of hiking boots. You paid, $100 for the pair of hiking boots. Is it a good thing if that pair of hiking boots are still in mint condition even 5 years later? Tell me, anybody? If your hiking boots are still shiny,
Yes.
even 5 years later?
Yes.
Oh, yes. Is that a good thing?
I think so.
Yeah, that's a
No.
bad thing.
I mean, if you said it's a
Worthless.
good thing, right? Pair of hiking boots. It's a hiking boot, so it must have a lot of jagged bottom, right? Like crocodile teeth, because you must get some traction, right? A lot of traction. If the hiking, if you might think, oh, if hiking boots are still in mint condition 5 years later, that must be a good thing because you can sell it. You can sell it and get you paid $100, so you might get something at least. But think about it. Nobody will pay used pair of boots for a used pair of hiking boots. Nobody will pay $100, right? I mean, even if it is in mint condition, maybe $50 5 years later. And 5 years later, the model, you can buy much better, something much better, 5 years later. But the point is, if the hiking boots are still in mint condition, even 5 years later, what does that mean? Have you used it? If it's in mint condition, that means you have never used it. Isn't that right? And another thing is, it didn't live up to its own mission. Right? Isn't that right? It never lived out its purpose. It never served you. Think about it. The purpose of the hiking boots is to serve you. In other words, so that you can work out. If you use the hiking boots then, and if you used it well over 5 years, this will be all tattered. You understand? It should be worn out. You understand? It served its purpose. The point of having these assets is so that they would serve their purposes. And so the company car, think about it, production equipment, if the production equipments are still in mint condition even 5 years later, what does that mean? It didn't serve its purpose. It didn't produce anything. Right? Think about it. Air conditioner. You have an air conditioner that was still in mint condition. It's 5 years old, but still in mint condition. What does that mean? It never served its purpose. It never worked. Right? Not that it is not working, but you never used it. If you didn't use it, why did you buy it in the first place? Right? Of course, hiking boots, you don't have to use it. It's up to you. But business assets, it's not an option. For business assets, it's not an option. If it's a business asset, it should live up to its purpose. Right? Does that make sense? Business assets, if they don't live up to their, if they don't live out their if they don't live out their designated mission, then the business assets never contributed to generating income for you. So that's not a business asset then, right? So does that make sense? If the car is your business asset, and if the service life, all the assets must have service life. Assets do have service life. And if the why? Because it will break down eventually. If you use them with age and with usage, it will wear and tear. And with wear and tear, right? With wear and tear, it will break down at some point. And that's only natural. So the car, the company vehicle, if it has lived up its purpose, then at the end of its service life, let's say 5 years is the service life, then the value of that must be zero. Right? It must wear and tear and fully disintegrate. That's the life well lived. Isn't it right? That's the life well lived for that car. That's the life well lived. If the pair of hiking boots are completely tattered after its service life, then it was a life well lived for that hiking boots. Does that make sense? Hmm? And when you die, if you are completely, if you're still in, like in baby skin, right? When you die, if you're in baby skin, I don't know, you haven't lived, right? If your brain, think about it, when you die, your brain, it better be, the brain should be all wrinkled. Of course, brain must have wrinkles. I mean, shiny, smooth brain is not a good brain. That's if the brain doesn't have any wrinkles, that means brain doesn't have any intelligence, right? Because the intelligence, the brain power comes from all those wrinkles in the brain. And the more you use the brain, the more wrinkles it will have. And by the end of your life, when you die, if your brain is all wrinklier than any other brains, then your brain has lived it has lived out its full purpose, and it has lived a good life for a brain. When you die, if your brain is still, just shiny and, smooth, that means, you're, throughout your life, your intelligence never gained. It's like, babies and just the baby's, intelligence. Of course, baby's brain is also wrinkly, but, as you grow older and as you grow smarter, your brain will get wrinklier. Right? So does that make sense? So think about it. If the company rented the car and paid $10,000 every year to use it, these are definitely business expense. Isn't it right? That's business expense. So that's why it goes into, it is reflected in the OPEX, operating expenses. Make sense? But then we're not renting the car. We bought the car. The company bought the car. Then what is the expense? If the company bought the car, actually there are two ways it could have bought it, right? First, they paid $50K upfront, right? Does that make sense? The company could have paid $50K upfront. They made full payment. So then 50K, so at time zero, right? Let's think about the timeline. At time zero, right? 1, 2, 3. Now you don't need this hiking boots anymore, right? So I'm gonna time 0, time 1, 2, 3, 4, 5. So this is end of the first year, end of the second year, end of the third year, end of the fourth year, end of the fifth year, right? Makes sense? But think about it. If you paid $50K upfront, and when I say you, it means the company, not you, an individual. Forget about individual. We're talking about corporate finance, right? So this car is owned by the company. They paid $50K at time zero. Then if they paid $50K at time zero, normally you would like to write, you would like to write off that expense in year one. Isn't it right? You want to write off that expense in year one. Are you following? Does that make sense so far? Are you following?
Yes.
Yes, Professor. Yes, Professor.
Okay, good. So, but then think about it. If you are writing off that $50K as an expense in year one, you all understand that will decrease the your taxable income by $50K. Why, you all know, I'm not going to go into the income, expenses, and in expenses, OPEX. If you write it off in year one, OPEX goes up by $50K, right? If OPEX goes up by $50K, that means EBIT will go down by $50K, right? EBIT will go down by $50K. And then you subtract interest, and then EBT, no matter what, it still is reflected, here. EBT goes down by $50K. Not EBT. Yeah. EBT goes, in other words, taxable income goes down by 50K. And then taxes will go down by whatever, tax rate, taxes will go down by not 50K, but go down by as much as tax rate times 50K, right? And if taxes go down, then obviously it's good for you, because then EAT will go up. Because if taxes are smaller, then EAT, net profit, will go up because you pay smaller taxes, right? But then this is a good thing for you, but this is a bad thing for whom? If taxes go down, it's good for you, but it's bad for whom? Who wouldn't like your taxes to go down?
Government.
Woman?
Yeah, exactly. To be more exact, it's IRS. IRS wouldn't like it. Don't you think? IRS wouldn't like it. Because, less tax revenue for IRS. IRS wouldn't like it. So, so who said that? Who said government?
I said it.
Huh?
Awa.
Ewa.
And Muhammad.
Mohammed. Okay, so
Awa. Ew, I don't know.
yes, this is fnb 230, right? Okay, AWA, right? Awa. And
Yes.
Mohammed.
Yes.
Mohammed.
MUKH.
Mohammed. What's your last name? MUKH.
No, my last name is Karimov. KARIMOV.
KAR Karimov. Okay, but first name Mohammed, right?
Muhammad, yeah.
Okay. So you guys got 0.5 for that. Yeah, of course. IRS wouldn't like that. Not only because, not just because the tax revenue goes down, but it makes it very difficult for IRS to make a forecast, right? Make a projection of the tax revenue. Think about it. Every year, many companies will buy. If there are, 1 million companies in the US, all these 1 million companies will buy either car or something, some fixed asset, machinery, production equipment, right? Whatever is, classified as fixed assets, right? And then if they buy these fixed assets at random, because nobody, think about it, to buy these fixed assets, they don't need to report it to IRS or get any approval from IRS, right? And then it can happen at random, right? And so 1 million businesses buy this and that, and as their fixed assets, right? As part of their fixed assets. And then if they want to write off all these expenses in year one, IRS has no idea what's going to be the tax revenue. Isn't that right? Because they are buying it at their own, at their own discretion. It's not like they are, reporting to IRS that we are buying this or something. Where, the acquisition of these physical assets is something that they do at their own discretion, and IRS has no idea. And so by the then by the end of the year when they file for tax return, and basically when they file taxes, right, by the end of the year, IRS may have unexpected big hole in the tax, tax revenue, right? Because this was never expected at all. IRS has no knowledge of what big ticket item company A bought or company B bought, right? So that's why instead of what IRS says is, instead of writing off this 50K in year one, why don't you spread it over 5 years? Why don't you spread it over 5 years and pretend as if you incurred 10K in year one, 10K year two, 10K year three, 10. So in other words, they spread it over 5 years. Then it will burn less smaller hole in the IRS's tax revenue, right? And think about it. The tax revenue is the source of what? The tax revenue is it's the source of government budget. Isn't that right? Tax revenue is the source of the government budget. And if you can't make a reliable forecast, dependable forecast of government tax revenue, right? If you can have no reliable, why is it like this? If you have no reliable revenue forecast, then there will be no reliable, right, budgeting. There will be no budgeting for government spending, right? Does that make sense? So this is why they can't allow writing off. This is why they cannot allow writing off 50K. They cannot allow writing off the whole purchase cost of the asset in year one. They want you to spread it over the service life of the asset. The service life of the assets are predetermined by the IRS. For vehicles, usually it is 3 to 5 years. 5 years. So that's what depreciation. That's why depreciation is shown. That's why depreciation is appearing in the operating expenses, right? And also in the balance sheet. So depreciation is artificial. Think about it. Car doesn't exactly depreciate by 10K a year, right? The reality is, I mean, in the first year, you may have driven it like 1,000 miles. In the second year, you're not driving it exactly by even mileage every year, right? Sometimes more, sometimes less, right? So the the usage will be uneven. But still, so that's why I'm saying depreciation is an artificial construct. No one really, the assets do not exactly depreciate at even rate every year. It's artificial, right? And on the balance sheet, the assets depreciate by, 10K, 10K, 10K. That is totally, artificial. But this way, in the income statement, what is happening in the income statement then? Between what is happening in the income statement is between year 2 and year 5, actually these are hollow, aren't they? It's a hollow shell. You understand what I'm saying? You didn't spend 10K in year 2. I mean, from year 2 through year 5, no expense was actually, no 10K was actually expended. Isn't that right? Because 50K was paid already at time 0. You incurred 50K at time 0. So everything happened in year 1. But you're artificially just making it look like, you spent 10K in year 2, 10K year 3, 10K year 4, right? So they are hollow expenses. Hollow shell. Right? Make sense? And what does this do? This has the effect of, think about it, you didn't, so then in year 2 through year 4, it has the effect of, although you didn't spend this 10K, you will have the effect of artificial 10K, spending of artificial 10K, right? So in other words, from year 2 through year 5, your operating expenses go up by 10K. That means your EBIT will go down by 10K, EBT goes down by 10K, your tax goes down by the tax rate times 10K. So your EAT goes up by that much, right? So in other words, this is a legitimate way of saving on taxes, year 2 through year 5. Okay, does that make sense? Everyone. Are you following?
Yes. Yes.
Okay.
Yes.
So,
Yes, Professor.
okay, so everyone understands, right? Everyone understands what depreciation does. So depreciation actually, that's why they call depreciation non-cash outlay. Non-cash outlay. What does that mean? What does non-cash outlay? That means, no cash was actually expended. No cash was actually paid, right? No cash was actually, but it's a hollow shell. That means, it's a hollow shell, which gives you a tax shelter or tax break in a way. year, not in year 1, but year 2, 3, year 5, that gives you a tax break, right? Your taxes go down by as much as tax rate times 10K every year, right? Between year 2 and year 5. So this is what depreciation is, okay? And the example I've given you is called, it's a straight line depreciation. Now, why is it called straight line depreciation? So let's take a look at our example, straight line depreciation. So in depreciation, there are largely two groups or two categories. One is straight line depreciation. The other one is accelerated depreciation. And the accelerated depreciation breaks down into two methods: sum of the year's digits method and declining balance method. Sum of the year's digit method is also called rule of 72. It's also called rule of 72. Okay. Oops. It's also called rule of 72. Why is it called rule of 72? I'm going to get to that later. So to understand let's do a little exercise on depreciation. First thing is, everyone go to this file, right? This is the file you've been using, right? Second bottom tab, depreciation, right? And let's delete all the highlighted cells. Delete highlighted cells. Back is aching. And then delete all the highlighted cells first. So in our example, the company bought a $50,000 car. That's called cost. And the salvage value, let's make it 500. What's salvage value? At the end of the service life, think about it. If the car has served its purpose well, if the asset has served its purpose well, then it will have to turn into nothing but scrap metal, right? If it has, so obviously this is an extreme assumption, but if anything has lived a full life, its full purpose, if the AC has served its full purpose, the air conditioner should, right, turn into its, just junk. If the car has served its, but of course this is only an artificial construct, because as I told you, depreciation is basically artificial. I mean, think about it. If you have taken a very good care of the car, the car would be still very nice even 5 years later. I mean, the car doesn't completely expire in 5 years. That is already artificial, right? That assumption, the service life, is an artificial concept. And if you have taken a very good care of the car, even after 5 years, you change oil, every 3,000 miles or every 5,000 miles, and do regular maintenance, the car will be still in a very good condition even 5 years later. And actually, resale value will be still, If not 50,000, it could still be 20,000. But you don't want to put $20,000 in the in your balance sheet. Why? If you put $20,000 after 5 years, then you are only depreciating 30,000. You are only writing off $30,000 as expense. You wouldn't like to do that. You want to fully reflect that $50,000 as expense, so that you would write off $50,000 as an expense over 5 years, so that you can fully benefit from the tax shield or tax break from that $50,000. You understand? So if possible, they don't even want to put zero for salvage value. They will put zero. They will put zero for the salvage value. They want, so 500 is the scrap metal value. I mean, it's a it's a piece of equipment. It's a car, production equipment, machine. I mean, wouldn't it have like $500 scrap metal value? Yeah, so the scrap metal value, the salvage value is usually predetermined or zero. Okay, and most companies would want to put zero for the salvage value. Life means service life, So rate is the depreciation rate. So the service life of this asset is 5 years. Again, this is artificial. Then the depreciation rate is just exactly the reciprocal of service life. Think about it. Every year, if the service life is 5 years, every year, 1/5 will be depreciated, which is 20%. Okay, then what's going to be the annual depreciation? Annual depreciation is then depreciation base. Depreciation base is the purchase cost minus salvage value. That's the depreciation base. Okay, of course, that's the part that you're depreciating, right? If the salvage value is zero, then the full $50,000 will be depreciated, and this will be multiplied by rate. So then annual depreciation will be like this. So then we can build the depreciation schedule, and the depreciation schedule, of course, at the big, every year it will be that, right? F4, and you want to lock it because you want to drag it down. So you want to lock it. So hit F4 and lock it, and you drag it down. So every year is like that. Accumulated depreciation or cumulative depreciation. And that's literally, you want to know how much depreciation has accumulated by the, by the end of the year 5. Accumulated depreciation should be exactly 49,500, right? And it will be. You will see. So in year 1, it's just itself, nothing else. In year 2, it will be annual depreciation plus the previous year accumulated depreciation, right? And then you drag it down. You see, at the end of year 5, it will be exactly 49,500. Book value. What's the book value? Book value is, at the end of the year. At time 0, at the beginning of year 1, the book value must be the cost, right? So at the beginning of the year, it is the purchase cost, but I'm gonna lock it because F4, and then accumulated depreciation. You subtract accumulated depreciation, then it will be the end of the year book value, right? End of the year book value, and then you drag it down. then by the end of year 5, the book value must be exactly the salvage value. It should be equal to salvage value. And if you build it like this, you will always end up with the salvage value. Right? The book value will always end up in the salvage value. Otherwise, it's wrong. And this becomes more important when we come to accelerated depreciation. Now, suppose the salvage value is 0, then it will adjust automatically. It will adjust, right? It will adjust automatically. Whatever salvage value you give there, it will adjust automatically. Okay. Now, that's the straight line depreciation, and we can have, partial year depreciation and when depreciation when life is not in years but in production level. Now, let's take a look at the accelerated depreciation. The first thing is rule of 72, or sum of the years digits method. What is the sum of the years digit? So let's say we have a 5-year, we have an asset with 5-year life, service life, but we don't depreciate at even rate. In straight line depreciation, we do it in even rate. And the book value, what is straight line? The book value is in straight line, right? Think about it. If we right, see, the book value goes down exactly. Book value goes down in straight line. I mean, I couldn't, okay. If I, right, connect, it's not good. Right, that's why it's called straight line depreciation, straight line, right? Okay, let me move this somewhere. But in accelerated depreciation, it's not declining evenly. So in this case, we are accelerating the depreciation in the early years. In the early years, right? Why? You want to depreciate more. I mean, if there is no depreciation rule, they want to write off expense, $50,000 expense in year 1. But because IRS doesn't want it, you spread it over 5 years. But then instead of spreading it evenly over 5 years, you want to put more weight in early years, right? That way you depreciate more, and the benefit of more depreciating more is the tax break, more tax shelter or tax shield in the earlier years, right? So usually what you do is, if the life is 5 years, right, you reverse the order, right? Because these digits will be the numerator of the fraction or the weight. So we know if you sum everything, it's going to be 15. So then what you do is, you assign 5 over 15, right? 5 over 15. It's actually not N5, L5. It should be here. Because in here, it's in column L, right? So let me do this. Okay. So L4, this is L4, right? Over L9, right? So then it's going to be 5 over 15, so 1/3, 4 over 15, 3 over 15, 2 over 15, 1 over 15. That way, the weight depreciation rate will be, right? That's, what's B5? This is it's pointing to the wrong thing. Okay, I'll have to, again, it's pointing to the wrong thing. B must all be L. L4. Oh no, 45. It's not 45, but 9. Yeah. Now, it's not dollars. It should be percentage, right? You're gonna use, at least 2 decimal places. Yeah, 1/3 is 33%, right? 4 over 15. So this is how it works. So here, let's do that. And in the old days, right? This is another way of quickly being able to get the sum of all those numbers, right? It's n times n plus 1 divided by 2. But these days, with Excel, with a computer, with the help of the computers, you can easily get the sum, right? Using Excel, you can just auto sum and you get this. So our example is the purchase cost of this asset is $18,000. Service life 5 years. And let's say salvage value is 300. Okay, then first, normally what I do here is, I copy this. And then I'll paste it here and reverse it here. So I will sort largest to smallest, right? And I will move it to You might wonder why. Why do you do that? If I do it here exactly, then the whole all adjacent columns get reversed too. So here you find auto sum, and the depreciation rate will be, of course, then this over this. Let's make it a little more interesting. First, how about service life 80 years, right? Then it will become a little unknowing, but I will then insert 3 rows. Okay, and then I will need to okay, then this should be L15, and then okay, and then I'll drag it down. Okay. Oh, no, this is wrong. This should be L15 through. Okay, now that looks better. And then if you sum everything, it should be 100%. Should be 100%, right? Yeah. And then, so this is depreciation rate. Depreciation amount, annual depreciation, whatever you call it. Then, again, depreciation base times the rate. Depreciation base is the cost minus salvage value and I will need to lock this so that I can, or lock this times the depreciation rate and then drag it down. And in the last here, actually you need to make adjustments so that the salvage value would be exactly this. You will need to make adjustment. If you don't make adjustment, it's in accounting they generally seem to accept it, but if you don't make adjustment, it is sloppy, right? So to make adjustment, what you need to do is, regardless of what the you have to it would be easier if I have accumulated depreciation, but for now, just to make it only in the last year. L12 minus right, whatever is so in the last year, you should arrive at the salvage value. Oh, I'm sorry. This is oh, okay. I got no. This is not the Okay, that's what should be. So this table is not complete. The book value, there should be a book value. I mean, if I have a column of book value, then I should do that, and accumulated depreciation and cumulative depreciation column of and column of book value, then I will do that. If I have column of okay, and of course accumulated depreciation in year one it's just itself. In year two is this time this plus whatever was above it, and we'll come to this. Book value is the purchase cost minus accumulated depreciation. Then you drag it down. Oh, no. What I forgot to lock it. You got to lock this. And then you exactly end up with the salvage value, and that's what a good depreciation schedule is looks like. You must end with the salvage value as the last year's book value all the time. Okay, if not, that's a sloppy job. It's not a good depreciation schedule. Okay, salvage value. All right, that's all the time we have. Any questions so far? Any questions? Anyone there? Anyone there? Any questions?
Yes, I'm here. I'm still here, but no questions, Professor.
Okay, all right, good. If you have no questions, then the class is dismissed. Well, have a great evening. Yeah, it's dark. Have a good night. And,
You as well,
we'll see you.
Professor.
Thank
All
you.
right, thank
Professor.
you.
Thank you.
So,
Bye.
take care now. Good night. I'll stop
Thank you,
sharing.
Professor.
And all right, take care. Good night. Stop sharing and stop.